In 2020, one hedge fund strategy produced a gain of more than 4,000% in a single month. In 1998, another hedge fund strategy lost so much money so quickly that the Federal Reserve had to organize a rescue to prevent a global collapse. What connects these two stories? Neither fund was gambling on tech stocks or trying to time the market. They were using obscure strategies most investors have never even heard of. Strategies that quietly move trillions of dollars through the financial system. Some of these playbooks look brilliant, others are so dangerous they destroyed entire firms overnight. But all of them reveal how hedge funds really make money when everyone else is left guessing. Today we'll uncover 7 hedge fund strategies that rarely appear in textbooks, but that explain how Wall Street's biggest players build fortunes, and sometimes how they lose them. At its core, statistical arbitrage, or StatArb, is about exploiting tiny temporary price discrepancies between related securities. The most famous example is pairs trading. Take two stocks with a long history of moving together, like Coca-Cola and Pepsi. If Coke suddenly drops, while Pepsi holds steady, a StatArb fund might buy Coke and short Pepsi, betting the relationship will revert. But modern StatArb goes far beyond simple pairs. Funds like Renaissance Technologies use sophisticated algorithms to scan thousands of securities across the market. They look for hidden relationships, not just Coke versus Pepsi, but basket of airlines versus oil prices, tech ETFs versus semiconductor stocks, or even cross-market links between futures and options. The trades themselves are often tiny, fractions of a percent, but funds place hundreds or thousands of them simultaneously, using leverage to make the gains meaningful. This requires super fast execution and enormous computational power. The risks are subtle but deadly. The entire approach assumes that historical correlations will hold, and that any divergence is temporary. But what if the relationships break permanently? In August 2007, many quant funds suffered massive losses in a few days during the so-called quant quake, when normally stable relationships all fail at once. Because so many firms were using similar models, everyone rushed to the exit at the same time, magnifying losses. Statistical arbitrage shows the double-edged sword of quantitative investing. It can deliver decades of outsized returns, but it can also unravel in days if the assumptions stop working. For most hedge funds, a few days of chaos is the ultimate nightmare. But for a rare breed of investors, chaos isn't a risk, it is the entire business model. These are funds that deliberately bleed small losses month after month, waiting for the one crisis that makes them rich overnight. This is tail risk hedging, or black swan investing. The idea is simple. Buy protection, like deep out of the money put options that almost always expire worthless. Most months, this is a drag on returns, but when markets collapse, those options skyrocket. During the COVID-19 crash in March 2020, Universal Investments, advised by Nassim Taleb, reported gains of more than 4,000% on its tail risk strategy. For investors with even a tiny allocation, those gains offset massive losses elsewhere. The challenge is patience. Few investors can stomach years of small losses for a rare windfall. Worse, not all prices behave the same way. Some tail hedges work brilliantly in sudden crashes, but fail in slow, grinding bear markets. Still, for pensions and endowments seeking protection, tail risk strategies are portfolio insurance, costly in calm times, invaluable in disaster. But if some funds wait for disaster, others gamble that markets will stay orderly, that bonds, the most boring asset of all, will trade in predictable patterns. And when that assumption broke in 1998, they followed, nearly sunk the global financial system. Government bonds seem safe, but hedge funds hunt for tiny mispricings hidden in the yield curve. Fixed income arbitrage means going long one bond and short another to exploit small differences in price. A classic trade is on the run versus off the run treasuries. The newest issues, called on the run, are highly liquid and trade at a slight premium. Older bonds off the run are cheaper. Funds short the expensive one, buy the cheap one, and wait for the price to align. Other variations include yield curve trades, swap spread trades, and mortgage-backed security arbitrage. Each exploit small basis points of mispricing. The danger is leverage. Because spreads are tiny, funds borrow heavily to magnify them. That's exactly what doomed long-term capital management. In 1998, run by Nobel Prize winners, long-term capital management built billions in leverage bets on bond convergence. When Russia defaulted, spreads blew out instead of narrowing. Losses spiraled, threatening the global financial system. The Fed had to coordinate a bailout. Fixed income arbitrage looks boring, but high systemic risk. It can produce steady, low volatility returns, until a shock tears apart assumptions. Long-term capital managed story remains a cautionary tale. Even the most brilliant models can fail when the world changes. Not every hedge fund strategy relies on abstract math or complex derivatives. Some focus on the oldest drama in business, mergers and acquisitions. And here the money isn't made by betting on growth, but on whether billion-dollar deals will actually close. Suppose Microsoft offers to buy a gaming company for $100 per share. The stock might trade at $95. A merger arb fund buys the stock at $95. If the regulators approve the deal, and the deal closes, it earns the $5 difference. In a stock-for-stock deal, for example, the fund might also short Microsoft stock to hedge. On paper, the returns look small, a few percent per deal. But because deals often close within months, funds can actually recycle their capital across many trades in a year. And because they are uncorrelated with market direction, merger arbitrage is attractive to institutions looking for diversification. Even famous investors play here. Warren Buffett described his Activision Blizzard investment during Microsoft acquisition attempt as a straightforward merger arbitrage deal. He was betting regulators will eventually approve it, closing the gap. But it is not free money. The downside is heavily skewed. If a deal collapses, the stock can plunge 20 or 30% or more. The 2001 General Electric Honeywell merger, blocked by European regulators at the last minute, cost arbitrators billions. Timing is another challenge. If a deal drags longer than expected, annualized returns can shrink. In short, merger arb is like picking up nickels in front of a steamroller, usually profitable, but the occasional accident can be devastating. We've talked a bit about stocks and bonds, but some securities are hybrids, part stock, part bond. Enter the convertible bond, a normal bond that pays interest, plus an embedded option that lets investors convert it into shares if the stock rises. That option exists because the issuer gives up potential upside in exchange for paying a lower interest rate on the bond. And since options gain value when prices swing, this hybrid benefits from volatility. Funds practicing convertible arbitrage buy the bond and short the stock. Why? Because the conversion feature is effectively a long volatility bet. If the stock moves a lot, up or down, the option becomes more valuable. Shorting the stock offsets gains or losses from price direction and isolates the volatility exposure. As the stock moves, the fund updates its hedge, buying or selling shares to stay neutral. This is called delta hedging and lets funds earn money when realized volatility exceeds what was implied when the bond was priced. Meanwhile, the bond still pays an interest, cushioning returns. The strategy flourished in the late 1990s and early 2000s, when convertibles were widely used and few investors priced them correctly. Titans like Citadel and Millennium built large convertible arb desks, but it is not riskless. In 2005, when General Motors and Ford were downgraded to junk, convertible bonds tanked, yet General Motors stock rose, punishing short positions. Liquidity vanished, hedges slipped, and funds lost billions on these bets. Convertible arbitrage proves a simple lesson. Hedging tempers risk, it never deletes it. Under stress, correlations can break in painful ways. Convertible arbitrage thrives when companies are healthy enough to issue new bonds. But what happens when companies are already collapsing? That's when distressed investors move in, buying debt for pennies on the dollar, and sometimes taking control of the company itself. These funds seek out companies in or near bankruptcy. They buy bonds or loans at deep discounts, sometimes as low as 20 cents on the dollar. The goal is to profit when the company restructures. Creditors often emerge as new shareholders after bankruptcy, swapping their discounted debt for equity. If the company recovers, that new stake can be worth far more. Distressed funds also wield enormous influence. They may negotiate directly with management, propose restructuring terms, or even push for asset sales. Some take activist roles, essentially becoming part of the turnaround. The approach isn't limited to companies. In sovereign debt crisis, distressed investors buy government bonds and fight for repayment. Elliott Management battle with Argentina is legendary. After years of legal fights, Elliott even seized an Argentine naval vessel to pressure repayment. Eventually, they walked away with a massive payout. The risks are equally dramatic. Not every company can be revived, and distressed securities can go to zero. Legal fights can take years. Political risk looms large when countries are involved, and in downturns, liquidity disappears, trapping investors in positions. Still, funds like Oaktree Capital, led by Howard Marks, have built empires by patiently waiting for crisis and then pouncing when assets are cheapest. Distressed debt is risky, but in the right hands, it can turn failure into fortune. But not all funds wait for bankruptcies or court battles. Some trade risk directly, using options and derivatives to bet on nothing more than the market's mood swings. Volatility itself is tradable. Options embed a market forecast of future volatility, called implied volatility. Volatility arbitrage is about betting that forecast is wrong. If implied volatility is too high, funds can sell options and hedge with some underlying of the stock. If actual volatility turns out lower, they keep the premium. If implied volatility is too low, they buy options cheaply, hedging direction, and profit if the stock swings more than expected. This isn't just theory. In February 2018, a day dubbed Bullmageddon, volatility spiked by its largest single-day jump in history. Exchange-traded products designed to short volatility collapsed, wiping out investors overnight. Funds positioned long volatility earned enormous gains. Volatility arbitrage is a constant balancing act. Selling volatility provides steady income until a sudden shock creates huge losses. Buying volatility bleeds money most of the time, but pays off spectacularly in rare crises. Professional vol arbitrage desks juggle complex instruments, variance swaps, fixed futures, and exotic options. They manage intricate risk, volatility of volatility, skew correlations. To outsiders it looks like gambling. In reality, it is about providing insurance, taking the other side of investors who want to shed risk. Done well, volatility arbitrage thrives on market psychology. Done poorly, one-way ticket to ruin. From distressed death battles in courtrooms to arbitrage trades measuring fractions of a cent, to tail risk hedges that only pay off in disasters, hedge funds operate on different playing field. These strategies aren't about guessing which stock will double. They're about finding inefficiencies, managing risk, and sometimes exploiting fear itself. They show that markets are far more complex than investors realize, and that fortunes are built not only on predictions, but on preparation. For retail investors, the lesson isn't just to copy the trades. Most require scale, infrastructure, and expertise. The takeaway is to understand that diversification, risk, and behavior matter as much as direction. Hedge funds don't just survive by being smarter, they survive by looking where others don't.